One common mistake many property investors make, especially beginner investors, is that thinking that buying an investment property will always result in a positive return. Hey everyone, Tuan Duong, founder of Durotax Quantity Surveyors, here for another video designed to help you become a better property investor. If you're looking to see positive returns on your property, you need to know that it doesn't happen overnight. Managing your property effectively will definitely help, but there are so many factors you need to take into account even before you buy the property. So today, I'm going to share with you 5 steps you'll need to take when getting ready to buy an investment property. You want to stick around till the end because each step plays a vital role in potentially seeing a positive return. Before we get into it, we want to be clear that this video is for informational purposes only. In no way should you interpret this as tax advice. We always recommend working with a qualified accountant or tax agent who can give you the best advice for your situation. Step 1. Can you afford it? In this first step, you'll have to set up a budget to see if you can balance your cash flow, income and expenses. I've seen beginner investors get hit with a nasty surprise once they realize that there are many added expenses come with buying a property. An excellent place to start is calculating if you can afford to pay a deposit. Banks usually want investors to pay a 10 to 20% deposit when buying a property, but can be as little as 5% at times where the government may encourage banks to lend to first-time home buyers. From there, you can see if you can afford to pay mortgage repayments, all the upfront expenses when buying the property and the ongoing costs of running the property. For example, when buying the property, you have to pay stamp duty. Stamp duty is a form of tax charged by the government to transfer the property from the seller to the buyer. Each state or territory decides how much stamp duty you must pay. For a property costing between $310,000 and $1 million in New South Wales, you'll pay $9,285 plus $4.50 for every $100 over $310,000. Stamp duty can poke a big hole in your budget if you're unprepared. At the time of making this video, stamp duty still needs to be paid in all states, but there have been talks of getting rid of it, so this might change later. Some other upfront and ongoing costs you should factor in are legal fees, property valuation and quantity surveyor fees, real estate leasing fees, land tax, and lender's mortgage insurance. Step 2. Consult with property professionals. Property investment isn't a one-person show. You need a team. Consulting with mortgage brokers, accountants, conveyancers, quantity surveyors can be worth far more than they cost. To find out more about property professionals, check out our video that covers the 4 property professionals you need on your side. Step 3. Pick your investment strategy. There is no one-size-fits-all strategy when it comes to property investment strategies. I see many investors, especially beginner investors, make that mistake of following what everyone else does. And what this usually means is that there are some pretty severe financial consequences if you don't know what you're getting yourself into. So, you need to pick a strategy that lines up with your future financial goals. For example, do you want to buy and hold long enough to generate capital growth? Or do you want to look for an old, broken down property, flip it and sell it at a higher sale value? Maybe one of the gearing strategies works best for you, or maybe a combination of strategies lined up better with your goals. Deciding on the best property investment strategy for you can be a daunting task, so make sure you watch our video that covers Australia's most popular investment strategies to help you pick the best investment path. Step 4. Find your property. There are a few things you need to consider when finding a property that suits your strategy. Number 1, is the property in an area where you can easily get tenants and experience property price growth? Number 2, what's the area's infrastructure like? Your investment property will be far more appealing to a tenant if there are good schools, restaurants, and public transport in the area. Number 3, is your property in a highly owner-occupied suburb? An investment within an area that has people desiring to buy and live there can have large merits for growth and rent values. Number 4, is the property suited for most tenants in the area? For example, if you're in a suburb close to a university, your demographic will be students looking for low maintenance properties. And number 5, are there ways to possibly add value to the property? For example, through renovations. Here's where consulting with a buyer's agent is valuable. They can save you lots of time researching the market and finding a property that lines up with your investment strategy. Step 5, after buying your property. Once you've found and purchased your investment property, the next steps will depend on your investment strategy. If you've gone with the flip it strategy, you want to get onto those renovations as soon as possible. or if you've gone with a long-term strategy, you want to make sure you're getting the most out of your tax deductions. To find out more about all the tax deductions you can claim, check out our video that covers 17 tax deductions you can claim on your investment property. But one vital deduction I want to talk about today is depreciation. I see so many investors miss out on the opportunity to save thousands of dollars each year because they don't realize the cash flow benefits of getting a depreciation schedule. When you think about the fact that depreciation is the second highest tax deduction on your property, it's unbelievable how many investors are leaving this on the table. A depreciation schedule is a report that outlines the tax depreciation deductions you can claim on your property. The great thing about claiming a depreciation deduction is that it's a non-cash deduction, so the only money you'll have to spend is on getting the report itself, which is also a tax-deductible expense. This can have a big impact on your cash flow. To get your hands on a tax depreciation schedule, all you have to do is get in touch with a quantity surveyor. We'll ask you a few simple questions to see if your property qualifies. Then about 5 to 10 business days, your personalized depreciation report will be delivered to you and your accountant. So there you have it, guys, the key steps to buying an investment property. If you have friends, colleagues, or family members who would benefit from this video, be sure to share this with them. I'm Tuan Duong. I'll see you guys next time.